It's a Tuesday night, and you're at the kitchen table with your laptop open, a calculator app on your phone, and a mortgage payment estimator you've refreshed about 11 times. The listing is still up in another tab. $400,000. 3 bedrooms. The photos have that specific kind of lighting that makes every room look 30% larger than it actually is. You've done the math. You know the monthly payment. You've budgeted it out. You've convinced yourself this is manageable. And the terrifying part isn't that you're wrong. The terrifying part is that you're only looking at one number out of about 12 that actually determine what this house costs you. Here's the thing. The mortgage industry has spent decades making sure you think about one number, the monthly payment. Because the monthly payment is the number that feels survivable. It's the number that gets you to sign. It fits inside a budget conversation. It sounds reasonable next to your rent. But the monthly payment is to your actual housing cost what a restaurant menu price is to your total bill after tax, tip, and the valet you forgot about. It's a starting point dressed up as the full story. The system isn't designed to show you the full story. It's designed to get you to closing day. And everything that happens after closing day, that's entirely your problem. I'm Cole, and today we're going to calculate what a $400,000 house actually costs you across 30 years. The number your real estate agent will never put in writing and your mortgage broker will never volunteer. Let's set the scene with where we actually are right now, because context matters for everything that follows. The median existing home price in January 2026 hit $396,800, according to the National Association of Realtors. So a $400,000 house isn't a luxury, it isn't aspirational. In most markets with any kind of job market worth moving to, it's just a house, maybe a garage, probably a yard the size of a generous parking space. The 30-year fixed mortgage rate as of this month is sitting around 6.1%, according to Freddie Mac. The industry is celebrating this like it's some kind of comeback story. Rates came down from 7% and everyone started popping champagne. But here's what that celebration is conveniently leaving out. A joint analysis from NAR and Realtor.com found that a household earning $75,000 a year, which is close to the national median, can currently afford just 21% of all homes listed for sale. In 2019, that same household could afford 49% of listings. 21%. Let me say that again. 21. So yes, rates improved slightly, and the market is still functionally closed to most people trying to buy in it. That's not pessimism. That's just what the data says. And then there's this. Bankrate published an analysis in December 2025 finding that the typical household needs to earn $33,000 more per year than they currently make just to afford the median-priced home comfortably. Not luxuriously, comfortably. $33,000 a year more. That's not a gap you close by skipping your streaming subscriptions. Okay, the $400,000 house. Let's build the real number piece by piece. You put 10% down. That's $40,000 cash handed over before your first mortgage payment. The median American savings account holds about $8,000. So if you're at the median, you're not slightly short of a 10% down payment, you're $32,000 short. But let's assume you have it. You saved hard, you did it. That leaves you with a $360,000 loan. At 6.1% on a 30-year fixed, your principal and interest payment is approximately $2,185 a month. Write that down. $2,185. That's number one. Now here's where most people put the calculator away. They shouldn't. Property taxes. The national average on a home in this price range runs about $3,030 a year, according to Zillow's November 2025 Hidden Costs of Homeownership study. That's $252 a month. And unlike your mortgage payment, this number doesn't stay fixed. It gets reassessed. It follows the market up. But let's use the national average for now. Running total, $2,437. Homeowners insurance. This one has been quietly becoming its own crisis. Insurance premiums surged 48% over the last 5 years, outpacing income growth by a significant margin, according to that same Zillow and Thumbtack report. On a $400,000 house, you're looking at roughly $167 a month nationally. If you're in Florida, Texas, or anywhere near a coast or wildfire risk zone, double or triple that number. but nationally, $167. Running total, $2,604. PMI. You put down 10%, not 20%, so the bank charges you a monthly fee for not being wealthy enough to put down more. Private mortgage insurance on a loan this size runs between $150 and $250 a month. Call it $175. Running total, $2,779. Maintenance. This one is what ambushes people. The Zillow and Thumbtack study found home maintenance costs average $10,946 per year nationally. That's $912 a month. Before you say that sounds high, this is what covers HVAC servicing, roof inspections, gutters, pest control, appliance repairs, the water heater that fails on a Sunday, the air conditioning that dies in August when you genuinely need it. It's not optional. Deferred maintenance on a $400,000 asset turns it into a $280,000 liability. You pay now or you pay more later. Running total, $3,691. Utilities: electricity, gas, water, internet. Conservative estimate on a modest single-family home, $375 a month. Final total, $4,066. $4,066. That's the real baseline cost of owning this house. Not the mortgage, not what the broker quoted you, the actual monthly number before one unexpected thing happens. Now, let's reverse engineer it. Financial advisors will tell you to keep total housing costs under 28% of your gross monthly income. If $4,066 is 28% of your income, you need to be earning roughly $174,000 a year. If we use the slightly more lenient 36% rule, you still need $135,500 annually. To comfortably own a $400,000 house, you need a household income between $135,000 and $175,000. Look around. According to the Census Bureau, fewer than 20% of American households earn $150,000 or more, which means roughly 80% of the country cannot comfortably afford what the NAR calls a median-priced home under any responsible financial standard. That's not a housing shortage, that's a structural disconnection between what homes cost and what people earn, and it has been growing for 5 straight years. Let me show you what this actually looks like in a real household. Meet Derek and Simone, combined income of $138,000. Derek is a senior account manager at a logistics company. Simone is a high school vice principal. Together, they earn nearly twice the national median. They're responsible, they're planners. They've been saving for 3 years for this down payment. By every conventional measure, they should be fine. They buy the $400,000 house. Here's what happens to their money. Gross, $138,000. After federal and state taxes, FICA, and their 401k, because they're planners, remember, they take home approximately $8,300 a month. Subtract $4,066 in housing costs. They have $4,234 left for the rest of their lives. Derek's car payment, he commutes 34 miles each way. A decent used car was non-negotiable, $410. Simone's car, same situation, different direction, $340. Car insurance on both vehicles, $260. Gas for 2 commuters in a suburb, $290. Student loans, Derek's MBA, Simone's education degree, $710. Groceries, 2 adults eating reasonably well, $620. Health insurance gap their employers don't cover, $380. Phones, $120. That's $3,130 in fixed monthly costs on top of housing, against $4,234 remaining. They have $1,104 left. $1,104. For clothing, for any medical copay, for anything breaking in the house that the maintenance reserve doesn't fully cover, for any semblance of a social life, for building any kind of emergency fund. Month 3, the inspector missed a slow leak behind the guest bathroom wall. The remediation quote comes in at $4,200. They don't have $4,200 sitting around because there was never enough room to build it. It goes on a credit card at 22% interest. Month 6, Simone's district announces budget cuts. Her position isn't eliminated, but her responsibilities double and her morale drops off a cliff. She starts looking at other opportunities. But she can't take a lateral move for less money because the mortgage payment has no flexibility built into it. She's locked in. Month 9, Derek offers him a role with more growth potential, lower base, higher commission potential. He can't take it. The base pay drop would make month 1 impossible. He stays. He watches someone younger take the role. This is the part nobody puts in the listing. The $400,000 house didn't just cost them $4,066 a month, it cost Derek a career opportunity. It cost Simone a professional exit. It cost them both the margin to make decisions freely. They own a house. The house owns them right back.
Let's name who benefits from Derek and Simone signing those papers. The bank collects interest on their $360,000 loan for 30 years. At 6.1%, their total interest paid over the life of that mortgage is approximately $426,000. They borrowed $360,000. They will pay back $786,000. The bank makes $426,000 from their desire to own a home. That is not a side effect of the mortgage system. That is the point of it. The real estate agent collected roughly $12,000 in commission on this transaction. Their legal and financial incentive is to close at the highest price possible as quickly as possible. There is no commission for telling a buyer the carrying costs might wreck them in year 2. The mortgage insurer collects PMI every single month until Derek and Simone hit 20% equity, which at this rate takes about 11 years. Their entire business model is built on the fact that most buyers can't afford a 20% down payment. They profit directly from the affordability gap. The insurance company raised premiums 48% in 5 years, faster than inflation, faster than wages, faster than any cost Derek and Simone were prepared for when they ran their original budget. Nobody in that transaction makes a single dollar when Derek and Simone look at the numbers and say, "This doesn't work for us right now." Not one person. The entire architecture of a home purchase is built to move you toward yes and keep you from doing the math that might produce a no. 4 myths, fast. Renting is throwing money away. Bankrate confirmed in 2025 that renting is cheaper than owning in all 50 of the largest metros in the country. All 50. Renting is paying for housing. Owning a house you can't comfortably afford is paying for housing plus interest plus PMI plus maintenance plus the privilege of being unable to leave. Neither option is throwing money away. One of them also involves a $426,000 interest bill. Buy now before prices go up more. People have been saying this since 2020. The people who bought at peak 2021 prices with 3% rates and watched rates double are not universally doing well. Urgency is a sales tactic. The best time to buy a house is when your specific financial situation makes it a sound decision, not when an agent tells you the window is closing. The bank approved you so you can afford it. The bank approved you at 43% debt to income. That is maximum exposure, not comfortable living. Confusing bank approval with financial comfort is exactly the confusion the bank needs you to have. They get paid either way. You're the one who has to live inside the number. It's always a good investment. Nobel Prize-winning economist Robert Shiller spent decades documenting that residential real estate appreciates at roughly 1% per year in real terms after inflation. 1%. The wealth people build through homeownership comes from leverage and mortgage paydown, not dramatic appreciation. A house can be a good financial decision. It is not automatically one just because you bought it. Here's the concept that reframes everything we've just covered. The economist and housing researcher Issi Romem coined what researchers now call the total cost of ownership gap, the systematic underestimation of what owning an asset actually costs when all carrying costs are included versus the sticker price. Romem's work showed that buyers consistently anchor to purchase price and mortgage payment, while mentally discounting insurance, maintenance, taxes, and opportunity cost, because those costs feel abstract at signing and brutally real 18 months later. The Zillow and Thumbtack study we referenced quantified this gap at $15,979 per year beyond the mortgage. $15,979. That's $1,331 a month the buyer didn't budget for because the system never asked them to. Applied to Derek and Simone, they bought a $400,000 house. They budgeted for a $360,000 loan. The total cost of ownership gap added $1,331 to a budget that had $1,104 of room in it. That's not bad planning. That's a gap the industry knows exists and has no incentive to close. When you understand the total cost of ownership gap, you stop asking, "Can I afford the payment?" and start asking, "Can I afford the house?" Those are two different questions. Only one of them matters. If this is the kind of analysis you want more of, no listings, no commissions, just the math the industry would prefer you didn't run, subscribe to Cole Capital. This is what every video looks like. Hit subscribe, and I'll see you in the next one. 3 specific actions based on where you actually are. If your household income is under $100,000 and you're looking at a $400,000 house, stop the search. Not forever, right now. Redirect that energy into 2 things: building your down payment past 20% so PMI disappears from the equation entirely, and watching what happens to inventory and rates over the next 12 to 18 months. A $40,000 down payment on a $400,000 house is not the same decision as an $80,000 down payment on the same house. The monthly difference alone is nearly $300, and PMI vanishes. If your household income is between $100,000 and $135,000, run the full number before you run the mortgage calculator. Take the monthly payment the broker gives you and add $1,331. That's the Zillow hidden cost average. If the total leaves you less than $1,500 a month for everything else in your life, you are not in a comfortable position. You are in a fragile one. Fragile positions break when something unexpected happens, and something unexpected always happens. If your household income is $135,000 or above and the full number works at 28%, meaning total housing costs, including everything, sit under 28% of your gross monthly income, then you are in the range where this can be a sound decision. But still run the 30-year calculation before you sign. Take your total monthly cost, multiply by 360. See the real number. Know what you are committing to. Then decide with your eyes open. The calculation takes 20 minutes. The commitment lasts 30 years. Run the math. There is no medal for buying a house that quietly dismantles your financial life one repair bill at a time. The listing will be there, another listing will replace it. The market will move, it always does, in both directions, regardless of what any agent tells you about urgency. What will not move is the math. The math is the math whether you look at it or not. The only difference is whether you looked at it before or after you signed. 1 in 3 people surveyed in 2025 said they no longer see homeownership as part of the American dream, not because they failed, because they did the arithmetic. The bank showed you the monthly payment. Nobody showed you the $1 million bill. Now you've seen it. What you do with that is yours to decide.